Okay, expense recognition, that's important as well as the revenue recognition. The expense recognition principle tells you that you record expenses in the same period as the revenues those expenses help to generate. So here's the idea is that you're going to record an expense in the same period that the revenues are recorded that are related. And that's important because you want net income on your income statement to be a good measure of how well the company operated. So what you have is revenues that were earned during the period. What you want to do is figure out how much you had incurred in order to generate those revenues and match those together. So if you think about it, this means that you can record an expense even if the cash has not yet been paid, or if the cash has been paid in advance. So you're going to have some differences. So let's go through an example with, we want to match all the wages that were incurred with the revenues that those wages help we want to record all the expenses with the related revenues. So if you have employees who've worked for you, you want those wages on the income statement in the same period as those revenues those employees help to generate. This is the case even if the company has not paid all those wages. So because of that, like with revenue recognition, you'll have expenses on your income statement, but you won't have the corresponding cash on the cash flows. In other words, we may be recording expenses in a different accounting period than when the cash is actually being paid. So what we have is the good old balance sheet to explain why the income statement differs from the statement of cash flows, why our expense is not the same as the cash paid. Well, you may have a situation where you've paid the cash first and then had the service or expense, the expense is recorded later. So when you pay for amounts in advance, you're going to decrease your cash, but instead of expensing it, if you haven't gotten the service, if you haven't had the service to help you generate revenues yet, then it's an asset called prepaids. Rent is a good example where if you pay for months of rent in advance, you haven't even gotten the service yet, so you shouldn't, just because you paid for that rent, be expensing it. Your net income would be misrepresented then. The other thing that can happen is that you might have expenses first. In other words, you might get the service first and not pay the cash until later. The balance sheet will have payables, which are liabilities on the books to show the amount that you've incurred but not yet paid. Another example that's typical is that companies, when they buy inventory, it's an asset initially. They won't expense it until they've actually sold it. And the idea is that you want to match the cost of the goods with the price of the goods that you sold, so that your net income represents your actual profit, your markup on the goods. Okay, so it's really important. And so you'll have cost of goods sold, which is an expense on your income statement, and you may not have paid for that yet. So you don't know whether the amount of, or if the goods that you've sold that you had purchased previously, whether you've paid for them or not, and it doesn't matter. When those goods go out the door, you expense them. So expenses are recorded when incurred, irregardless of whether the cash has changed hands.